Welcome to Illuminati Silver's Inner Sanctum, where we tell you the truth about precious metals, banking, economics, and politics. Today is Thursday, the 27th of December 2018, and we're updating our Inner Sanctum members as to where we believe we are in relation to gold and silver and the stock markets. Having witnessed their movements in recent days, and silver hitting and slightly surpassing that significant psychological barrier of $15 an ounce. Now, we first start off with a small caveat. We are this week operating within an environment of low volume markets, as many traders and investment players are on holiday. And so the effect is that relatively small buy or sell orders accentuates price movements more than they would under normal market conditions. Having said that, we must also be aware of the fact that what is happening should not be surprising, as to some extent the Fed has paved the way for us by providing us with a blueprint via issuing its forward guidance and strategy for interest rates well into next year. At the time of writing, gold stands at $1,269, silver at $15.03, and the Dow having closed yesterday at 22,878, up 1,086 points. The Nasdaq at 6,554, up 361 points, and the S&P at 2,467, up 116 points. So far, this has been a bullish trading week for gold, with prices hitting a 6-month high, thanks to dollar weakness and heightened political uncertainty in the United States. As we have mentioned in our weekly update and other videos and podcasts, that market sentiment remains fragile amid geopolitical risk factors, and depressed equity markets have punctured investor confidence. Interestingly, we saw Christmas Eve having the largest fall for a Christmas Eve ever, while Boxing Day, major US equities posted their best session in nearly 10 years. And the Dow Jones achieving its best one-day performance ever in its history. So what are we to make of this? Investors will now be asking, is this just a rebound in a bear market trend, or have we just gone through a dip in a bull market and are now moving back on course for a much higher Dow Jones and stock index? Our first gut reaction is that it's too early to tell, as we are operating where the market is not fully populated with its usual players. However, we ourselves must also revert to our video and article within the Inner Sanctum entitled, "Why is Wall Street Freaking Out and Economists Aren't?" In this video, we point out that for the time being, Wall Street knows that its cheap money, or free money, handout is now over. Interest rates have risen and may very well rise again, probably twice again next year. Growth forecasts have fallen in the eyes of the Fed to around 2.5% at best for 2019, and so the days of achieving super high stock valuations based on unrealistic growth figures may at last be coming to an end. And of course, the markets do not like this. That said, there are a number of stocks which make up these key indices which are actually doing quite well and may be above trend growth, and others, of course, which aren't. So our natural inclination, without going deep into the figures, is that we may begin to see a more modest stock market, possibly in a bear market territory with dips and rises on occasion, sometimes significant, and on others more consolidatory in practice. In our view, and we've said this often, a more benign or consolidatory stock market at this stage is actually good long term. We may very well have headed off a bubble that could have significantly burst, sowing carnage in all other markets. That said, and we have to caution this, the unpredictable Trump factor, like him or not, will have an influence, at least short term. At the moment, the US government is in shutdown, And Trump has much to lose politically if he caves into the Democrats. And the Democrats have much to lose if they cave in to funding the wall without obtaining a significant payback in some other area, for example, DACA or the right to citizenship for dreamers. And so the shutdown could continue well into January. And it's not illusionary to suggest beyond January, though we suspect by then the stakes will have reached unbearable heights for both sides. Now, this is not devastating for the economy, let's be blunt about this, but it still adds a small undermining factor to market confidence. That is, another debilitating factor. We foresee China as having more significance. Our contacts tell us both sides really do wish to make a deal, but neither can afford to lose face. With Trump currently in a somewhat state of political turmoil, this gives China the edge to stick the knife in, metaphorically speaking. But it also knows that a cornered animal can do nothing but attack. And so some form of agreement is in the interests of all parties. And we sincerely believe this will happen in the new year, though it may be closer to February than the beginning of January, we suspect. Coming back to the Fed and gold and silver. Notwithstanding what we've just said, it is also clear to markets that although the days of free money is over, it is also aware that 0.5% is probably the highest rates will be raised in 2019, and also that the Fed will become data dependent when this figure of 3 to 3.25% is reached. This is actually a moderately dovish tone, and markets can adapt to this. We must all remind ourselves that technically the Fed's responsibility is to achieve full employment over the long term and curb inflation, operating within its declared target of symmetrical 2%. So if there is a downturn in the economy and unemployment begins to rise, providing inflation is not an issue, it may then have to start lowering interest rates again. We have to ask ourselves, too, the effect on the dollar that this will have and on precious metals. At the time of writing, the US dollar is standing at 96.68, down from 97.2 a little over 10 days ago, despite an intervening rise in interest rates. We now know that the next Fed rate rise is unlikely until probably next March. And so the only thing really that can cause the dollar to strengthen significantly from here are either higher corporate earnings or stronger economic figures such as lower unemployment and higher retail sales. Now there may be some good news here, but again it's too early to tell for sure. Data released by MasterCard Spending Pulse showed retailers were having their best holiday season for 6 years. Retail giant Amazon rose 9.45% after the company said it sold a record number of items this holiday season, though we doubt whether high street sales would match these figures. So there is further potential for the US dollar to rise, but in our view, less than there was. Now, this does not mean that we expect the dollar to crush, far from it. We still believe it to be one of the best currencies around at the moment. And certainly when compared to the euro, which will soon have some further problems, a new video on that one to follow, and sterling, which is going to find it incredibly difficult to prosper until Brexit negotiations are concluded. So what do we say? We're basically saying that increasing dollar strength is limited and its downward impact on gold and silver prices will be less than it has been. Our conclusion, therefore, is that as we head into 2019, the sentiment pendulum for gold is swinging in favor of the bulls due to the following factors. 1. Only 2 interest rate rises likely next year indicates a more dovish approach by the Fed. 2. Political turbulence such as the US government shutdown. 3. Issues still unresolved with China. 4. Lower growth concerns for 2019. 5. North Korea perhaps not playing ball may compel Trump to take more decisive action. 6. Political fallout over Trump's foreign policy. 7. A new Congress, which will immediately begin proceedings and subpoena many of Trump's inner sanctum to give evidence before them. And 8. The traditional seasonal rise in gold and silver prices at the start of the new year. In addition, although yesterday's rally was welcomed by investors, the markets are not out of the woods yet. Some question its validity due to low holiday volume. Others are saying the strong rally merely offers short-term relief from an otherwise turbulent month or two ahead, and that we could see a technical bounce into the end of the year due to profit-taking and position squaring. However, we're not likely to see a sustained rally until investors regain their confidence in the Trump administration, Congress, and Federal Reserve. These are the main positive elements for a rise in the price of gold and silver. Conversely, of course, as gold is to some extent correlated to the stock market, should the markets resume its buoyant and bullish nature into 2019, then gold profit-taking could occur, and we see prices falling back again towards $12.50 and then possibly lower. Gold having hit its highest level since the 9th of July this year, it did fall back below the 9th of July top of $12.84, and what many technical analysts view as a key resistance level of just over $12.85. So one cannot totally discount the view that despite the positive shift in investor sentiment, the price action suggests gold traders have little faith in the news developing into something major. Now let's take a look at silver, which frankly has been a star. And as we said 2 weeks ago in our Saturday weekly roundup, that we expected gold and silver to break outside its $100 and $1 trend the following week. And we have to confess we were a week out, certainly for silver, though gold hasn't so far quite managed it. What none of us knew was whether that trend was going to be higher or lower, and it has now been indicated. Yesterday, silver closed at $15.03 and currently stands at $15.04 as we have got to this stage of the video. In other words, it's gone up 1 cent in the last 20 minutes or so. We envisage it rising higher than this. Now, this may surprise some of our listeners, but we can see from charts and the fact that silver closed above $15 yesterday and held its position this morning in UK time, it will have an appetite to go higher. How much higher? Well, we see resistance at around 15.20, and this is such a slim market at the moment, it could stretch slightly beyond that and attempt to reach 15.50. That said, we are uncomfortable at this stage predicting that silver is going to continue beyond that until we can see more clearly what is happening when all of the traders actually come back from their holidays next week. Meanwhile, we have to grapple with a low volume market, allowing these prices to move almost wherever they will based on relatively small purchases and sales. One thing for sure is that it will move contemporaneously with gold, but at a slightly higher level proportionally. As with the gold to silver ratio of what was 86.4 at one point in November and now 84.4, some correction is likely, though we do not see that correction falling much below 82. So uncharacteristically, our view is that one should sit on one's hands and wait to see how this plays out next week. Once we are confident of the true trend based on full figures and trading, we can then more accurately predict not only direction but also levels, well, within reason. In other words, it's quite possible that by the end of January we may very well see $17 silver, but we may also see $14 silver by the end of February. This has been a long podcast, but as we're still on holiday in Hampshire, we wanted to at least share with our subscribers that whilst we do not believe gold and silver have necessarily reached their lows as yet, we will fully admit that the pressure at the moment leads more towards their rising than falling. But again, cannot stress enough that we believe we're talking about perhaps up to $60 gold and $2 silver more, and not the outrageous figures being seen on the internet by the doom and gloom merchants. Could we be wrong? Well, yes, of course we could. Are we likely to be? Well, let's wait and see. It's still that little too early to be fully confident of a trend reversal, though we're quite firm that the equity markets have perhaps seen their all-time high in 2018, and it will prove exceptionally difficult for it to surpass that level in 2019. And frankly, for the sake of maintaining a non-bubble environment, which would only lead to a massive burst, it's probably better off for all concerned that it doesn't. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we're not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.